Startup fundraising is about to get a whole lot trickier in 2026. And as a VC who's raised $16 million myself and watched founders secure over $60 million in 2025, I've seen the rules start to flip. So in this video, I'm going to show you what's really shifting, the new mistakes to avoid, and how you can actually raise money in 2026 with this new environment. So what's the first big shift? Well, it's that VCs aren't actually chasing what they used to, if I'm being honest. Because if you're building a startup and you're trying to raise startup funding in 2026, you'll notice something strange. And what's happening is that the flood of capital that once chased every single SaaS idea is suddenly just drying up, and you're wondering what's happening. And instead, what you're seeing when it comes to Twitter, when it comes to all of those kind of things, is that the money is laser focused on a few different sectors, things like AI, things like infrastructure, things like deep tech with robotics. And what I want you to do is I want you to think of venture capitalists like people with metal detectors on a crowded beach. A few years ago, they'd dig up anything shiny they found, whether it was coins or bottle caps or whatever. They'd find something and they just want to invest into it. But now they're only interested in if the detector pings for gold. And if you're not gold, meaning you're not in AI, you're not in infrastructure, you're not in deep tech and specific types, you're going to need a really compelling reason for them to actually want to dig. And if you are in those sectors, because there's so many of them around, you'd better prove you're not just gold plated, for example, like slapping AI on your deck and calling it a day and hoping that's what you need. So what does that actually mean for you to raise funding in 2026 then? Because if you're not building an AI or one of those hard sectors, well, then you need a sharper edge, if I'm being honest. You need a unique, undeniable reason for why you're fundable and why they actually want to spend time with you. And if you are building an AI or deep tech or robotics or anything like that, you need to prove that you're the best founder they have and you're not just another tourist like every other founder that's trying to do, slapping AI onto their deck or onto a basic product because that's what they've been told to do. But how do you actually do that if you're in one of these sectors or you're even not? Well, if you're outside the hot sectors, I want you to get crystal clear on what makes your solution essential and most importantly different. Because if you're raising to enable AI into your business, you'll need to be super early and have actual data or knowledge of what it will improve, not just maybe. So I know I'm working with a founder right now and we're tinkering with how we word everything to make sure that they understand that what he's building is going to make everything better. And those are the main questions we're getting and whether or not he's going to be able to fundraise. If you've actually been building your business in the last couple of years and you're actually in one of these hot sectors, then you need to show actual real depth because most of the companies out there are not showing real depth, a lot more than previous years. So you need to focus on why you're solving that problem that only you can, how your tech isn't just a buzzword or an add-on, but a real game changer and distribution actually makes sense and you can actually sell this. And thirdly, it's actually defensible against every other copycat or competitors that's trying to do the exact same things as you. But it's not just about where the money is going. It's also actually about where it's being handed out. And that's what brings us on to shift 2, which is that capital is actually back overall, but it's concentrated in fewer seed and series A bets. And this fundamentally changes how you should be thinking about raising startup funding in 2026 and how you need to be setting yourself up. Because you might hear that startup funding is up compared to 2023. And to be honest with you, that's actually technically true. But the thing is, it can still feel like the money has vanished. And there's actually a reason for that, which is that investors in 2025 and also going into 2026, it will be the same. They're actually writing the same amount of money, but are actually, or even more, it's increasing, but they're actually writing fewer checks, but for bigger amounts. So what's happening is that they're being pickier than ever about who gets through and only picking some of the best instead of multitude of companies. So in the last year alone, where I've seen founders, I work with raise over $60 million, the biggest shift I've seen is investors are demanding more due diligence than ever. They're really digging deeper. They're asking tougher questions, spending more time on research. And I've even seen some term sheets pulled at the last minute far more often than when I was raising pre-COVID. And it's because VCs are concentrating their bets on fewer companies, and that means you have to be operating at the highest level just to get in the game and be ready. I've seen that across so many different companies. People like Charlie, who raised $5 million with me recently. We started and it just kept getting longer and longer, and we had to be thinking about much longer time frames before we get the term sheets. It was exactly the same when it came to Vishal with his £4 million round, as well as Marco with his £2.2 million round. It was all the exact same. So what does this actually take to get through this new, tougher process then? I want you to think about it in 5 different steps on how you can make sure you structure your raise with 2026 in mind. Firstly, I want you to have a much more structured fundraise, because investors are concentrating on a few of the best founders and not investing into as many companies as before. You need to treat your fundraise like a campaign, not just a casual sprint or something you're just going to randomly do. So you need to build out a clear investor target list, reach out to each one, do your outreach in the right way, create momentum and scarcity. And that's what brings us on to the second point, which I want you to build your network early. Don't just wait until you need money to start making connections. Get introductions from other founders, from angels, from mentors. Warm intros are the price of entry, even more so because AI has made cold emails go crazy. Investors are getting spammed, and they're only investing into the best, and the best are always from warm intros. Thirdly, you need to perfect your pitch and story. Investors want a founder who can communicate a big vision, clear traction, and a credible plan. And it's only ever more important in this time frame because they only invest into the best. So you can't just go into a meeting and wing it and feel like your charisma is good enough. You need to practice your pitch until it's sharp, making sure you're answering tough investor questions and showing investors that you're the best founder there are. Number 4 is running a tight fundraising process. The best founders are being as super organized as possible. They're running it professionally. They're sending updates, answering questions fast, making investors feel like you're operating at that next level. That's the way they need to feel. And then number 5 is just preparing your materials in the right way. Now, this is the least important one, if I'm being honest. Most of the people do this anyway. The first 4 is where most founders go wrong. You have to have your deck, your data room, your due diligence docs ready before you start, because as soon as you start having to do that during the funding round, they're going to be lower quality and it's going to take more time, and there's going to be other founders that VCs look at that will say yes to you instead of you. So these are the things that you need to make sure you're prepared enough for your raise, because investors are only backing the best prepared, the most compelling founders. And if you want to get the funding you need in 2026, then you need to run your process like a pro more than any other year before it. By the way, if you want a step-by-step guide on exactly how to structure your fundraise, build your network, and nail your pitch, then check out the link down below where I break down the whole process in detail so you can actually put this into action. Now, let's say that you even get your seed round done, or you have previously. I don't want you to get too comfortable, because the real challenge is around the corner, and what's happening now in the seed market is fundamentally changing how startup funding works in 2026. And that's exactly what Shift 3 is. Because a lot of founders think that once they've raised a seed round, they're set. But in 2026, and what we've seen over the last couple of years, is that the real bottleneck is Series A. And because of the bottleneck of Series A, it's actually affecting seed rounds more and more now. So companies have historically been able to raise a seed round quite comfortably, but most of them have hit a wall when it comes to raising their Series A. It's called, the Series A gap, and have failed to raise future funding rounds. But now what's been happening over the last couple of years, and especially in 2025, is it's getting harder and harder for companies to raise their Series A. And what happens is that investors can feel this in their portfolio. Every day, they're seeing companies failing to bridge the gap and know how tough Series A has become. And what's happening now is that they're actually now starting to think about it when they're evaluating you at seed a lot more than they used to. So VCs are, from what I've seen over the last year in the funding rounds I've done, VCs are looking ahead and asking, can this founder actually hit the milestones for a Series A? and actually rejecting companies purely for that reason. So just getting the seed round done and not thinking about the future isn't enough anymore. If you're optimizing for a quick seed without a clear plan for Series A, you might not actually get funded at all because you're not going to be able to show investors you can reach the Series A milestones, which is the biggest worry that they have right now. So what do you need to do to then survive this new reality then? What I want you to do is I always want you to think one round ahead. So whether you're raising a pre-seed, a seed, a Series A, I want you to know exactly what investors at the next stage want to see. So which types of traction, which types of metrics, team, what business model you're building, and then the proof you have to get to product market fit. The second thing I want you to do is I want you to actually prove you can hit Series A milestones. So I want you to show seed investors you're already thinking about what it takes to Series A and lay out your roadmap. It may be wrong, that's okay. But you need to be confident in what you're doing, how you're going to do it, the metrics you're going to track, and how you're going to build real traction to be able to raise the Series A in 1, 2, 3, 4 years, however long it's going to be. Next one is I want you to build investor confidence. Make it clear that you understand the fundraising journey. Talk openly about your plan for Series A, not just your immediate goals. And when talking about what the money is being used for when you're raising this round, explicitly say that it will get you to the milestones you need to raise the Series A, and that it's pretty much a given you're going to be there. What I expect is that the graveyard is going to be full of startups that raised a seed but couldn't make the jump to Series A again. But even more so, there's going to be a higher and higher chance, as we've already seen, of companies not being able to raise seed because investors just can't believe that they're ever going to be able to raise a Series A in the future. It's not just about founders feeling the pressure, as I've said throughout this whole video. VCs themselves are also under the microscope right now, and that's going to affect how fundraising is for you as well, because funds are under pressure too. As exit and liquidity is slowly reopening, it has over the 2025, it's not been at a fast enough pace. So you might think that because they're starting to come back, IPOs and acquisitions, VCs are going to start throwing money around again. But for most VCs, they're still quietly struggling. They've not been able to actually make any money for their investors, which are called limited partners. And what's happening is they're still tight on cash. They've not been able to show that they can actually invest and sell companies in the right way. So their investors are not giving them more money. And VCs are becoming more conservative with new investments they make and are much tougher on follow-on investments. And I was very, very worried about companies which has happened in the last 5 years, where they've invested and they've not been able to show the VC making money. I've spoken to at least 10 VCs in the past 6 months saying exactly this. These funds used to move quickly and are now just dragging their feet, taking longer to make decisions, and are second guessing themselves, as well as holding out for founders who can prove a clear path to liquidity. And for some, like 2 or 3 of them, they're not even investing at all because they just want to kind of take a blank slate and see what's happening. So even when exits are picking up, VCs are obsessed with seeing how your company will actually get to a real exit, not just top line growth. And they're scared to invest into companies that will cause them even more pain if they fail. So I just want you to realize that even though the headlines say the market is opening up, the truth is that VCs are more cautious than ever. And they're being more ruthless. And they're laser focused on ownership, the follow-up potential, and your path to a real exit more than anything. So what does that mean for you as a founder then when you're trying to raise startup funding in 2026? Well, I want you to be transparent about your exit plan. Now, obviously, it's probably going to be wrong, but I don't just want you to talk about growth. I want you to show investors how you believe you have a credible path to liquidity, whether it's an IPO, acquisition, or something else. Second thing is you need to realize that VCs now need to show their returns to their investors. So they're looking for companies that can deliver real outcomes, not just I'm going to grow to 1 million users and then see what happens. Thirdly, you need to expect slower processes. Be prepared for longer decision cycles, more meetings with investors, more wait and see behavior. And you need to make sure that you're running your process so you have as many investors as possible in your process so you can keep it wide and more competition. And lastly, you need to show why you're a safe bet. So show why you're worth backing. within how you're going to raise your Series A and highlighting your traction, your milestones, and the steps you're taking to de-risk the business for everyone involved. VCs are under pressure to pick winners and avoid losers. And if you want to stand out, you need to make it easy for them to see how you'll deliver a real return, not just a good story anymore. And with all that pressure on both sides, there's one rule that's become non-negotiable, and that's what Shift 5 is. So back in 2023, and honestly for years before that as well, it was always about like how many engineers you had or how quickly you could hire a big team. Founders would drag on about headcount as a sign of progress. But in the AI age, honestly, that's completely flipped. So if you want to raise funding in 2026, you need to prove how capital efficient you are, because that's really what investors are looking for, and it permeates through all of the different things that we've talked about. And you need to show how much you've achieved with as little as possible. From my time as a VC, and thankfully my fund, we didn't really invest into these companies, and they didn't do very well either, but I saw founders get rewarded just for building big teams. But now, after mentoring founders through the last year, I've watched that thinking evaporate, to be honest with you. The questions around big teams and growing teams and just doing everything in that way has completely shifted to capital efficiency, revenue per users, really focusing around scalability, around growth. And the companies getting funded today are the ones that show they've made real progress, whether it comes from distribution, traction, product, but keeping their burn super low and having leeway in what they're doing. Because investors want to see that you're not just spending for the sake of it like we were before, but actually scaling smarter and faster than the competition so that you can reach the right milestones, that you can scale efficiently, that you can exit in the right way. So capital efficiency is not just a nice to have anymore. It's the ticket to your next round and making sure you get the funding to build your business. And if you can't show investors you're amazing at stretching every dollar, you're making it so much harder to fundraise in 2026. So what does that actually look like? Well, the first thing I want you to think about is actually make sure that you prep your fundraise early enough. If you're running out of money and you don't have money in the bank because you've not prepped your fundraise early enough, investors will see that and they won't think you're capital efficient. The second thing is I want you to raise the right size round. Don't raise too little and don't raise crazy. The third thing I want you to do is I want you to make sure that you have a lean team. Don't hire for the sake of it. Focus on mission critical roles that are top tier, that are best in class, and show how you're leveraging AI and automation to do more with less if possible. And that last one is obsess over burn and runway. You need to know your numbers more than anything. You need to be ready to explain how you'll stretch your capital and what milestones you hit before you need to raise again. So to wrap it up, raising startup funding in 2026 isn't about hype or headcount or luck like it used to be. It's about proving that you belong in 2026 by prepping your fundraising the right way, being efficient in how you're doing it, always thinking one step ahead and showing that you can raise future rounds. And if you want to get funded and not just pitch endlessly, you've got to play by these new rules. Otherwise, you'll be wasting months on end, failing to raise, and in the end, potentially shutting down your business, which none of us want. Now, if you want these exact frameworks, templates, insider tactics for building your investor list, structuring your outreach, and nailing your pitch, then what I want you to do is I want you to check out the link below, because what I do is I break down everything step by step so you can skip the guesswork and raise with confidence, even in this tougher environment. And if you want to learn the exact system that has allowed founders like Hatim, Derek, Marco, John, Yuji, and others raise $60 million this year, then check out this video next.